Yeah, I think what's interesting, obviously, so first of all, there's the decision on interest rates, OK? So they've raised interest rates by 0.25 percentage points, a quarter of a percentage point, lower than some people had expected. And of course, that reflects the fact that inflation, while still very high, isn't quite as high, isn't quite as much above expectations as it was not that long ago. So that's kind of the main thing. The other thing to focus on, because as well as that, you also get the forecast from the Bank of England, you get more signals of what they're planning to do in future. That, in a way, is more interesting this time around. Obviously, there's an instant impact to those interest rates going up, and you will see that if you're on a floating rate mortgage, you'll see that reflected almost instantly. But what's also important is the curve. What's expected off in the future from interest rates? And here, there is a new bit of language from the Bank of England signalling that they're expecting to have higher interest rates for longer than they previously might have signalled, essentially saying that even if interest rates aren't going to get up to that level that some people had talked about, getting towards 6%, even if the peak isn't quite as high as had been expected, you can still broadly expect that interest rates are going to be quite high. And what does that mean? It means maybe kind of 5% or so for quite some time. So higher interest rates for longer, maybe not peaking quite so high. But of course, that has a bearing for many people out there, millions of households looking at their mortgages, working out whether they're going to refix now, working out whether it makes more sense to refix in the future. Well, the bank is signalling that actually interest rates aren't going to be going down anytime soon, or at least it's going down a lot anytime soon. And that is quite an interesting hint. They're all doing it through the signalling that they tend to do, so it's through various different messages within the minutes. But nonetheless, it's worth taking account of that. And the upshot of that, I mentioned that there are forecasts as well of what's going on with the economy. The upshot of higher interest rates for longer is that it means the economy is weaker for longer. So when you're looking at their growth forecasts, I mean, we call them growth forecasts, but there is no growth in there. It's basically flatlining all the way through for another 3 years, 3 lost years of growth, some people would say. So only by 2026 do you see anything like relatively strong, and I'd say relatively by the standards of the last few years, strong growth. So that is effectively rather depressing. But the good news is essentially they don't no longer think that inflation is above where they previously thought, and they do expect it to start coming down. Indeed, thanks to those higher interest rates, they expect it to be down to around 2% by the end of what they call their forecast horizon. So that's in kind of 2-3 years' time. But as I say, the messaging is those rates, even if they don't peak quite so high, are going to be high for quite a long time, which you know, that's quite significant for many people out there making these decisions. Worth saying finally, though, Wolf, you know, it's not just about borrowing rates. These are the interest rates that they set here at the Bank of England that then get adopted by banks around the country when it comes to their mortgages, but also when it comes to savings. And for many people who have had to put up with very low savings rates for many years, it is frankly a relief that finally savings rates are starting to go up, albeit not as high as a lot of people would like, albeit that banks aren't necessarily passing on all of those increases through to savers. But there is a large proportion, you know, talking about potentially more than 50% of the population, who are able to enjoy those savings rates because they've paid off mortgages and they aren't necessarily facing too much in the way of debt. So that's the big picture here. We're going to be hearing from the Governor, Andrew Bailey, a little bit later on. There's a press conference. We'll talk to him as well. So there'll be much more detail on this. And this is one of those meetings where it's not just about the number. It's about expectations and what you can expect from interest rates going forward.
Ed, do just stick with us. I want to get your response from a couple of statements that we've just had crossing whilst you've been talking. The first one coming from Rachel Reeves, the Shadow Chancellor, saying that the latest rise in interest rates will be incredibly worrying for households across Britain, already struggling to make ends meet. She says responsibility for this crisis lies at the doors of the Conservatives. Well, the government, the Chancellor's response, of course, as you would imagine, strikes a different tone, saying if we stick to the plan, the bank forecasts inflation will be below 3% in a year's time without the economy falling into a recession. But that doesn't mean it's easy for families facing higher mortgage bills. So we will continue to do what we can to help households. Just want to quickly get, Ed, your reaction to those two themes that come out of those statements. And relative to expectations coming into today is the news that we've had, which, of course, involves another tough rate hike for homeowners, but also involves some different economic forecasts than we had previously. Does it come as a slight positive surprise for the Conservatives, or as an ongoing disappointment as framed by Rachel Reeves in Labour?
Well, I think, if you listen to what Rachel Reeves was saying, I mean, for millions of households up and down the country, that is their lived experience right now. A lot of people, and we talk to them, all the time, they are looking at their mortgage statements and they're seeing those envelopes coming in with dread, because they know that each different decision, and it is a relatively small portion of the population who are on those floating rate mortgages, who so get that impact every single time there's a decision like this. And it's the 14th successive decision that's gone up. That is, an incredibly stressful and financially difficult period. And for those households who are on mortgages right now, particularly those who have big mortgages, particularly those who are relatively young, who have not necessarily overextended themselves, but extended themselves quite far to get on the housing ladder, to upgrade, to move up the rungs of the housing ladder. This is really tough right now. In fact, it is potentially as tough as it was for families with mortgages back in the late 1980s. Of course, we all know what happened after that. It led to a housing bust. It was really tough. You had negative equity. You had a recession following it. However, the difference is the number of households who are facing those higher levels of debt, those mortgages, is smaller now than it was in the 1990s. And so the upshot is the impact on the economy isn't quite so severe. It's more drawn out. It's less acute. It's more drawn out, which goes back to that point that the bank was making, it that, regardless of where those interest rates end up at the moment, even, assuming nothing unexpected happens, and frankly, they've got their forecasts wrong quite a few times before, so, we can presume there might be mistakes in the future. Based on kind of where things look like they're heading at the moment, it's not about the peak, it's more about the length that we're staying at high interest rates of kind of 5% or so. That is potentially 3 years of really high interest rates not coming down as quickly as had previously been expected. In terms of the Chancellor, this is kind of significant because you'll remember that he has this pledge to try to halve inflation by the end of the year. And actually, the bank has said, on the basis of its central forecast, it does look like he will meet that. So he's not going to break that pledge. That would mean, so inflation was kind of over 10% when he made that pledge. The kind of level at which he meets it is anything below about 5.4% inflation, the consumer price index inflation. The bank says it looks like it's around 4.9% by the end of the year, but there's still some time. We don't know. Like I say, the inflation forecasting has not exactly been perfect here. And there is maybe a 20% chance within those forecasts that he misses it, even if those forecasts are right. So he will be cheered by that. He'll be cheered by the fact that there's no recession, as he mentioned in that statement. But nonetheless, this is not, looking at the numbers here, this is not an economy which looks especially healthy. It's flatlining, and it's flatlining not just for a few months, but for a few years, even beyond the difficult, challenging times that we've had over the past few years. And so while we have just about got back to the kind of peak in terms of total national income that we had before COVID-19, we're basically now flatlining for quite some time. And when you compare the UK to other countries around the world, particularly the United States, not so much the case in Europe. In many